Well, you may not be getting as much as you had thought or hoped you would from your tax return this year. So we're skipping ahead to next year and getting advice on what you should do now differently so that hopefully it'll make a difference for next year. Financial advisor Mike Piershale joins us now.
Hi.
So Mike, last year, the time is behind us, so we have to try to look to the future. And so are there definitive steps that people can take to begin maximizing their efforts?
There are. One of the things that we find is very, very common with people when we talk to them is that they are actually saving money above and beyond what they're putting into their company retirement plans. And they're just either throwing it in the bank or putting it in a mutual fund. And often these same folks will not have gotten to the maximum contribution they can put in the 401k, which is actually $17,500 for 2013. And if you happen to be 50 or older, like myself, you can put in another $5,500. So what we'll encourage them to do is start saving more money on a monthly basis in these retirement plans instead of just throwing it into a taxable account. For example, somebody puts in an extra $5,000 in their 401k. If they're not maxed out, they're getting basically the equivalent of a $5,000 tax deduction, which can save some taxes, plus doing themselves a favor and saving money for their retirement.
You also mentioned buy tax-favored investments.
Right. Now, basically, here's what we mean by that. There are certain investments like stocks, for example, that the income is treated tax favorably. Therefore, we don't want to waste that tax advantage by putting them in a retirement account where you can't take advantage of the tax status.
Could you give us an example?
For example, on a stock, the income on a stock is taxed as a long-term capital gain. So if somebody's in a 10 or 15% tax bracket, the tax on their stock is zero, which is a sweet deal. If they happen to be in the 25 to 35% bracket, the tax on their stock dividend is only 15%. And of course, if they're in a new highest bracket, 39.6, the tax is 20%. So why not take more of that stock and leave it outside the IRA where you can enjoy this tax favorable treatment? Same thing with tax-free municipal bonds. Right now, very safe tax-free municipal bonds are paying 4.5%. If you're in a 25% tax bracket, 4.5% to you is like getting 6% on a taxable investment like a bond or a CD. So we recommend putting those types of investments outside the retirement accounts and then put more of the fully taxable investments like fully taxable bonds, real estate investment trusts that are taxed with the worst kind of tax, ordinary income tax, put those in the retirement account.
And finally, should we double check our returns to make sure there are no mistakes there?
We should. Let me tell you, a very common mistake that we see on a tax return is where when we look on a tax return and see that the amount that a person sold an investment for is triple their basis. Basis is a fancy word for what they paid for it.
Right.
Many times, 7 out of 10 times, it's a mistake. And often what happens, the CPA doesn't have the original price that was paid for that investment. They ask the client to go get it. They get an original confirm showing the original amount paid, but forget about reinvestment of dividends, which raises the basis. And remember, the more the basis, the less tax, because basis is not taxable. So the thing we always caution people is on your tax return, on your Schedule D.
We've got to wrap this up.
Okay.
But the bottom line is make sure that that return you're getting, that you can double check it some way for mistakes.
Absolutely.
Because that can be costly.
Absolutely.
Great.
Tax costly.
Well, thank you so much. We appreciate your visit here. And for more useful tips, be sure and visit PiershaleFinancial.com.